Are you ready to unlock the secrets of smart investing? Index funds, mutual funds, hedge funds, ETFs, these terms might sound like complex financial jargon, but they are powerful tools that can shape your financial future. This guide will demystify them, helping you build a robust portfolio for the long term. Stick with me, and I'll walk you through everything in plain, practical language. Whether you're just starting your investment journey or looking to refine your strategy, this video is designed to empower you with knowledge. Remember, this is for educational purposes, not financial advice, but it will equip you to make better, smarter decisions. This video is not sponsored. Everstead is fully independent. No paid promotions, no outside influence. Just honest research to help you invest smarter. Let's begin at the very beginning. What exactly is a fund? Imagine a group of people pooling their money together for a common investment goal. Instead of each person buying individual stocks or bonds, they contribute to a collective pot. This pooled money is then professionally managed. It gets invested across a diverse range of assets, such as stocks, bonds, real estate, or commodities. This collective approach allows individual investors to gain exposure to a broad market without needing vast sums of capital. The core benefit here is diversification. By spreading investments across many different assets, a fund significantly reduces risk. If one particular investment performs poorly, the impact on your overall portfolio is cushioned by the performance of others. This prevents your entire financial future from riding on a single company's success or failure. Professional management is another key advantage. Funds are overseen by experienced managers or sophisticated algorithms. They handle the complex tasks of research, asset selection, and portfolio rebalancing. This takes the burden off individual investors, making sophisticated investing accessible to everyone. Every fund has a net asset value, NAV, which is essentially its per-share price. The NAV is calculated daily by taking the total value of all assets the fund owns, subtracting its liabilities and expenses, and then dividing that by the number of outstanding shares. Understanding NAV is crucial for knowing the true value of your investment. For both new investors and those planning for the long haul, funds offer unparalleled advantages. They simplify the investment process, making it less daunting to start building wealth. You don't need to be a stock-picking expert to participate in market growth. Funds provide instant diversification, which is a cornerstone of sound portfolio planning. Instead of buying one or two stocks, a single fund investment can give you exposure to hundreds or even thousands of companies. This significantly reduces idiosyncratic risk, the risk associated with a single company's performance. Moreover, funds are ideal for long-term wealth accumulation. Their diversified nature helps smooth out market volatility over time. This allows your investments to benefit from the power of compounding, where your earnings generate further earnings, leading to substantial growth over decades. They also offer cost efficiency. While some funds have higher fees, many are designed to be very low cost, especially passive funds. This means more of your money stays invested and working for you, rather than being eroded by excessive charges. Finally, funds offer flexibility. You can choose funds that align with your specific financial goals, risk tolerance, and time horizon. Whether you're saving for retirement, a down payment, or simply building general wealth, there's likely a fund strategy that fits your needs. Now let's delve into index funds, often hailed as the golden child of the investing world. You've likely heard the advice, just put your money in an index fund and let it grow. But what exactly makes them so effective? An index fund is a type of mutual fund, or ETF, that aims to replicate the performance of a specific market index. It doesn't try to beat the market, it simply mirrors it. Think of an index as a predefined list of securities, like the S&P 500, which tracks 500 of the largest US companies. An S&P 500 index fund, for example, will hold all 500 of those stocks in the same proportion as the index. If the S&P 500 goes up by 1%, your fund aims to go up by approximately 1%, minus minimal fees. If the index goes down, so does your investment. This strategy is known as passive management. The beauty of passive management lies in its simplicity and cost-effectiveness. Since there's no active manager constantly buying and selling, index funds have significantly lower operating expenses. Their annual fees, known as expense ratios, can be as low as 0.03% to 0.20%, making them incredibly efficient for long-term investors. Historically, index funds have proven to be remarkably successful. Over extended periods, the vast majority of actively managed funds fail to consistently outperform their benchmark indexes after fees. By simply tracking the market, index funds capture the broad market's returns with consistency and minimal cost. For beginner investors, index funds offer an ideal starting point. They provide instant, broad diversification across an entire market segment, or even the global market. This reduces the need for individual stock research and decision-making, simplifying portfolio planning. For long-term investors, index funds are a cornerstone. Their low costs and consistent market-matching performance make them powerful vehicles for compounding wealth over decades. Companies like Vanguard, Fidelity, and BlackRock, through their iShares ETFs, are prominent providers of these highly effective funds. A minor operational point for traditional index mutual funds is that they are priced once per day, after the market closes. This means, if you place an order during trading hours, your transaction will be executed at that day's closing NAV. This is generally not a concern for long-term investors focused on accumulating shares over time. Next, let's explore mutual funds. While they share some similarities with index funds, a key distinction lies in their management style. Many mutual funds are actively managed, meaning a team of professional fund managers makes ongoing decisions about which securities to buy, sell, or hold. The goal of active management is to outperform a specific market benchmark, such as the S&P 500, or to achieve a particular investment objective. Managers conduct extensive research, analyze market trends, and employ various strategies to identify undervalued assets or capitalize on market inefficiencies. This human touch aims to generate superior returns. However, this active approach comes with a higher price tag. Mutual fund fees, known as expense ratios, typically range from 0.5% to 2%, or even more annually. These fees cover the costs of research, trading, and management salaries. Some mutual funds also charge loads, which are sales commissions paid when you buy, front-end load, or sell, back-end load, shares. Despite the higher fees and dedicated management, studies consistently show that most actively managed mutual funds struggle to outperform their benchmarks over the long term, especially after accounting for their higher costs. The challenge of consistently beating the market is immense, even for seasoned professionals. That said, mutual funds can still be valuable tools for specific investment goals. They offer access to specialized sectors, niche markets, or unique investment strategies that might not be available through broad index funds. For instance, you might find mutual funds focused on emerging markets, specific industries like biotechnology, or particular investment styles like value or growth investing. For investors who believe in a specific manager's expertise or want targeted exposure to a particular segment of the market, mutual funds can be a viable option. However, it's crucial to carefully research their historical performance, fee structure, and investment strategy before committing. Like traditional index mutual funds, actively managed mutual funds are also priced once per day at their net asset value, NAV, after market close. This makes them less suitable for day trading, but perfectly adequate for long-term investors who are not concerned with intraday price fluctuations. Now let's briefly touch upon hedge funds. These are often shrouded in mystique and associated with high finance. Despite their name, which suggests hedging or reducing risk, many hedge funds actually employ aggressive strategies to pursue exceptionally high returns, often involving significant risk. Hedge funds utilize a wide array of complex and sophisticated investment techniques. These can include short selling, betting on a stock's decline, leveraging borrowing money to amplify returns, derivatives, private equity investments, and global macro strategies. Their managers have considerable freedom to invest across various asset classes and markets. A critical characteristic of hedge funds is their exclusivity. They are typically only open to accredited investors, individuals, or institutions, meeting specific high income or net worth requirements. This regulatory barrier is in place because of the inherent risks and complexity involved. The fee structure for hedge funds is notoriously high, often following a 2 and 20 inches model. This means a 2% annual management fee on assets under management, plus 20% of any profits generated. These substantial fees are designed to compensate managers for their specialized expertise and the potentially high returns they aim to deliver. For the vast majority of beginner and long-term investors, hedge funds are not a suitable investment vehicle. Their high minimum investments, complex strategies, lack of transparency, and significant risks make them appropriate only for ultra-wealthy and highly sophisticated investors. Understanding them, however, helps to grasp the broader landscape of financial instruments and their influence on market dynamics. Finally, let's explore exchange-traded funds, or ETFs. ETFs have rapidly grown in popularity because they offer a compelling blend of features from both index funds and individual stocks. They truly represent a best of both worlds scenario for many investors. Like most index funds, the majority of ETFs are passively managed. They aim to track a specific index, such as the S&P 500, a bond index, or a commodity index. This passive approach means they benefit from the same low expense ratios and broad diversification as traditional index funds. However, where ETFs truly differentiate themselves is in their trading flexibility. Unlike mutual funds, which are priced only once a day, ETFs trade on stock exchanges throughout the day, just like individual stocks. This means you can buy and sell ETF shares at any time during market hours, and their prices fluctuate in real time. This intraday liquidity offers investors greater control and responsiveness. This flexibility makes ETFs incredibly versatile for portfolio planning. You can use them to build a diversified core portfolio with broad market exposure, or to target specific sectors, countries, or asset classes. There are ETFs for virtually every investment theme imaginable, from clean energy to emerging market bonds. For beginner investors, a broad market ETF or an S&P 500 ETF can be an excellent starting point. They provide instant diversification, low costs, and the ease of trading like a stock. For long-term investors, ETFs offer a highly efficient way to implement strategic asset allocation and rebalance portfolios with precision. Many ETFs also trade commission-free on popular brokerage platforms, further reducing the cost of investing. Their transparency, low costs, and trading flexibility make them a cornerstone for modern portfolio construction, appealing to both new investors seeking simplicity and experienced investors desiring granular control. So with all these options, how do you decide which fund is right for you? The choice ultimately depends on your individual financial goals, your tolerance for risk, and your investment time horizon. For most beginner investors and those focused on long-term wealth accumulation, index funds and ETFs are the clear winners. They offer simplicity, broad diversification, and remarkably low costs. Their passive nature means you capture market returns without the need for constant monitoring or high fees. An S&P 500 ETF, or a total market index fund, can form the bedrock of a robust, low-maintenance portfolio. Actively managed mutual funds might be considered if you have a strong conviction in a specific fund manager's strategy, or if you seek exposure to a very niche market segment not covered by passive options. However, always scrutinize their fees and historical performance carefully, as many struggle to justify their higher costs over the long run. For long-term investors, the drag of higher fees can significantly erode returns over decades. Hedge funds, as discussed, are generally not suitable for the average investor. Their high barriers to entry, complex strategies, and significant risks make them exclusive to ultra-high net worth individuals. Focus your energy on accessible and proven investment vehicles. When planning your portfolio, consider your risk assessment. If you are risk-averse, bond funds, or more conservative balanced funds, a mix of stocks and bonds, might be appropriate. If you have a long time horizon and higher risk tolerance, equity-focused index funds or ETFs can offer greater growth potential. Ultimately, the best strategy for long-term investors often involves a diversified portfolio built primarily with low-cost index funds and ETFs. This approach allows you to participate in the broad growth of the economy, minimize costs, and benefit from the power of compounding over many years. Regular contributions, regardless of market conditions, are key to maximizing this strategy. If this video has helped you understand the landscape of investment funds and how they can fit into your financial plan, please do me a favor. Hit that like button, subscribe to Everstead, and share this valuable information with someone who's just starting their investment journey. Your support helps us create more educational content. Now, it's time to take action. Begin by clearly defining your financial goals. Are you saving for retirement, a down payment on a home, or simply building a general wealth fund? Your goals will guide your investment choices. Based on these goals, explore a few fund options that align with your plan. Start small, be consistent, and commit to learning as you go. If you're ready to take the next crucial step, check out our next video. I'll guide you through the practical process of how to actually pick your first fund, open a brokerage account, and get started with investing. It's easier than you think, and the sooner you begin, the more time your money has to grow. Thanks for watching, and I'll see you soon on your journey to financial empowerment.